much on this slide because we spoke about this already. But just to point out the that the combined gains, 398 million on average. All right, and these gains are shared also by the target shareholders. In other words, the company that was targeted, so the company that is acquired or merged. All right. So target shareholders are 43%, and acquiring shareholders 57% of the gains, the synergistic gains. So it suggests that cross-border mergers and acquisitions are very, what's the word I should use, are lucrative, all right? Because there are gains to be made, and there are gains that are enjoyed by the shareholders on both sides, both by the target and the acquiring, all right? So we note here that British acquisitions gave a negative combined wealth gain. It was less, all right? And so it's 28 million on average, and so you had a wealth transfer from the acquiring shareholders to the target shareholders, which is a little different. I mean, usually the acquiring shareholders would benefit more, but in this case, in the UK, the target shareholders acquire. So because you are invested in another country, you face political risk, all right? Political risk is, those are the potential losses from adverse political developments in the country in which you are investing. And so you have expropriation of foreign assets, all right? Unexpected changes in tax laws that will hurt the profitability. You also have political risks that arise from just instability that arises from changes in the political environment, all right? So you have, the risks are huge, and they're divided into two categories, macro risk and micro risk. So your macro risk is where the foreign operations, all foreign operations are affected, all right, by the adverse political developments in the host country. So things like wars, if you have non-democratic institutions where power can change very quickly, then it means your tax laws, your tariffs, just about everything that should be helping the firm, the multinational firm, those things can change overnight, right? Then you have the micro risk, so selected areas of the foreign business are affected. So sometimes it's just the general political environment, and then other times it's just smaller areas, so that is called micro risk.
So macro risk would be, like, example would be Trump wants to deport the Hispanics for whatever reason from the country. So the loss of the manpower can affect the businesses. So that comes under macro risk, right?
I would see that one as micro risk because that affects everybody. The deportation of the cheaper labor will affect everybody, because trust me, I think every company uses that. All right. And not only, the thing is with that, and it's a little sad, but they are illegal. It's very sad, is that those persons tend to do much better work than
they need to.
Right. Because they're trying to keep those jobs, huh?
Mm-hmm. Exactly.
Trying to keep those jobs, and so they do better quality work. It's not get paid and go home. They're trying to hold on to those jobs. Okay, so depending on how the companies are affected, there are three types of political risk. You have the transfer risk, operational risk, and control risk. All right, so transfer risk is where you are moving money, all right, and your money could get stuck somewhere. Because if a government changes and the new government that comes in places exchange controls on you, if they put in place exchange controls, it means you can't move money freely. You have to get permission to move a certain amount of money. All right? And so there's not that free transfer. And so what's in transition as it's happening could be affected. All right? Then you have operational risk, of course. So whatever happens in country that's going to affect the local operations, so unexpected changes in environmental policies, sourcing local inputs, minimum wage law. Minimum wage law may increase minimum wage, you didn't expect it, you have not factored that into your budget, you have not factored that into your financing arrangements, and so that will affect your operations. Right? Restriction on access to local credit facilities, that could happen. All right? So those are going to immediately affect your operations. Then there's control risk. Okay? That comes from the uncertainty about how the host country's policy regarding ownership and control of local operations happen. So, for example, you can't just come into Antigua and start a company just like that. All right? You have to go through some procedures and processes. If you come in and start a company, you're going to be subject to withholding taxes, you're going to be subject to a number of things that local companies are not subject to. And so the laws of ownership and control, if those laws change when the government changes, then it affects the company. All right? So capital controls. Sometimes we in the region don't have capital controls between islands because we have the securities exchange. So that when you make money, if you invest in a stock and you sell it on the securities exchange, the money you make, you are free to take it. There's no taxes on it. You get it. However, in your country, when you get that income, if you have income tax, you'll have to pay taxes on it. But outside of that, no, there are no controls. And I spoke about withholding tax. So if you have a withholding tax, it's a tax where when you make money in a company that's not a local company, you're required to pay withholding tax, right? So the easiest example is, you see when we bring artists here for shows and so on, the money that you pay the artists, the promoters are supposed to take tax out of that money.
Okay.
For withholding tax, right? Most times it doesn't happen. All right? And it doesn't happen because you can't trace, you almost cannot enforce it, because most of the artists request payment in cash. They almost can't trace it. All right? You can only trace it if the promoter submits their financials and they have a line in there as the fee for the artist, right? And then who suffers? It's the promoter who will suffer, because the promoter is gonna have to pay that money, right? Promoter will have to pay that withholding tax, which he or she has already paid the artist their full amount, right? So that's what we refer to as, when we talk about control list. So it's capital controls based on ownership rights. So those things could change overnight if there's a change in political parties.
Okay.
All right. So when you're looking at, as a manager of a multinational corporation, there are a number of things that you have to be looking at, right? So we know the translation exposure, the transaction exposure, whether you expand further or not. So you have the risks. How do you analyze these political risks? What are the things you need to look for? So you want to look at the host country's political and government system. So you want to look at the trend. Is it a stable political environment where when there's an election, there's a smooth transition? It's not like the US now, which was not the case before, where all of a sudden you have these tariffs, you have all of these changes, all right? So in the past, the US would have not been taught to have major political risk, because it's a democratic society, it's capitalist, and so everything should have been smooth. But multinational companies operating in the US today, they are facing significant political risk, all right, because of the tariffs and so on. So you look at the government system. Is it a socialist system? Is it democratic? Is it a dictatorship? So you're going to look at those things. Does the host country have a political and administrative infrastructure that allows for effective and streamlined policy decisions? How do they make policy? How do they make laws? Right? Can the cabinet just get up and make a law? No, they have to go to parliament. All right, and the opposition, and you have the opposition in parliament and the ruling party. So what you find happening with multinational, when people are coming in to do foreign direct investment, they speak to both the governing party and the opposition. You may wonder how come the opposition is so involved in this Alpha Nero issue. Right? This doesn't just have to do with a passing interest and in the interest of the people. It means that somebody involved with Alpha Nero on the other side, and I said other side, like the lady who's trying to get the monies, somebody in her camp had to speak to opposition politicians. Right? It's just not a passing interest, and that's what companies that are trying to come in do. They speak to both sides, and the minute they don't get what they're looking for from the government, they are going to go to the opposition and cry foul. It's natural. All right, it doesn't throw any shade on the opposition, or it's just what they do. Okay. If a country has too many political parties and frequent changes in government, then your government policies could be inconsistent and discontinuous, so that creates political risk. You look at the track record of political parties, all right, as somebody coming to invest in the country. So you look at the ideology. So somebody who is serious about foreign direct investment in Antigua and Barbuda, they're going to go and they're going to read the manifestos of those political parties that they would have issued however long ago, and over time they're going to read through those, They're going to see, did they keep their promises? They're going to see over time, and for Antigua and Barbuda, they would have a history, a track record. So what has the ALP, now ABLP administration, done over the years that it's been in government? What has the UPP, which was a merger of PLN and a couple of other parties, done when they were in government? What's their track record? All right? And so you would have seen, if you were conscious enough, many of you maybe not at that time, 2014, most of you would have been just what? In second or third form. Many of you may have just been, right? So you may not have been conscious, but there were things that happened immediately after the government changed. All right? There were things that happened in terms of how businessmen would have reacted to that. In terms of what kind of foreign direct investment you saw come in. Because people on the outside have been studying what's happening. That's what they do. So as a manager of a multinational, you need to look at these things. So the track record of the political parties, their relative strength, if you can, are you able to get to one minister and be able to get what you would like to get, because that one minister has more power or more local standard in government, and you as a manager of a multinational will target certain ministers of government. So you may look at Minister of Foreign Affairs. Everybody wants to get to the Prime Minister, but yes, he's Prime Minister or she is Prime Minister, but you may not be able to get through to the Prime Minister, so you're going to go to another minister. All right?
You might say that one doesn't know how corrupt the government is, right?
Yes, yeah. They look and see what are the reports.
Yeah.
And they're going to speak to other companies that have had experiences in the country. So it says here, a party that subscribes to a liberal and market-oriented ideology is not very likely to take actions to damage the interests of foreign concerns. If the former party is more popular than the latter party and thus more likely to win the next general election, multinational corporations will be a more political risk. All right? Look at how the country integrates into the world system. Is the country politically and economically isolated and segmented? So, are we a Cuba? Are we a Venezuela? You know? So they look at that as well. Because those countries are less likely or less willing to observe the rules of the game. So you look at the connection with the rest of the world. All right? Then of course there's country risk. Some people will say that country risk is the same as political risk, but it's not. Country risk is broader than political risk because it includes all of the risks that come with investing in a country.
That's sovereign risk.
All right?
Is it sovereign?
Sovereign or country risk, yes. So it includes the political risk, it includes the credit risk, it includes even the foreign exchange risk and the overall economic performance of the country. All right? So when you are assessing or determining when one company is determining if it should invest in a country, all right, you can actually incorporate that into your capital budgeting process and adjust your NPV. So if you think there's political risk, there's a likelihood that tax laws may change and your corporate income tax or your withholding tax will increase, then you include that in your NPV calculation. So you would, when you're doing your NPV calculation, you will use your operating cash flows, right? And you use discounted operating cash flows. So in your operating cash flows, when you are calculating your operating cash flows, you have your total income. You're gonna back out you're gonna add in your depreciation, and then you're going to work out your tax. All right? So you get your so you work out your tax and you get your net profit. All right? Or your net operating cash flow. Then you add back your depreciation, so that's the amount you're going to discount. So what you would do to factor in your political risk, if you think the risk is taxes, then you would increase your tax percentage so that you would reduce your operating cash flow that's used to calculate your NPV. If the political risk has to do with regulation, all right, let's say tariffs, let's say quotas, then that's going to affect your operating cash flow, and so you're going to reduce that operating cash flow when you're calculating your NPV. All right, so that is how we adjust for political risk when you are making a decision to expand. Because if you're making a decision to expand to another country, you're going to be looking to see the NPV of that project. To get the NPV of that project, you need to see what your cash flows are going to be over the next 10 years, 20 years, to see if you can recoup your investment, right? And so you would put a price on that element of political risk and any other risk, and adjust your cash flows accordingly. Because as a manager, as a CEO, as a chief financial officer, and you're doing any sort of expansion, you want to be sure that the expansion is worth it. All right? So you reduce expected cash flow, or you increase your cost of capital. You use your cost of capital to do what? You use your cost of capital to do in your NPV calculation. Who's doing FM now? Who's doing FM now? Put up your hand high. Hi. Come on, Heaven, put up your hand. What do you use your cost of capital for when you're doing NPV? When you're doing the NPV, what do you use your cost of capital for? Huh? You already passed FM, right?
I'm doing FM2 right now.
You do FM2? Ah, good. So what is the cost of capital? What you use it to do? No. I said in NPV, what is it you use your cost of capital to do? Oh Lord, y'all gonna fail y'all exam. Huh?
The internet says that's the discount rate to determine the
Thank you, Internet.
future cash flows.
You're going to use your cost of capital as your discount rate to discount your cash flows. So if the question comes and it tells you your cost of capital is 10%, and it don't tell you your discount rate is 10%, please use the cost of capital to discount your cash flows and not leave the question blank. Okay? All right, so you would either reduce your expected cash flows, or you would increase the cost of capital to factor in the risk. All right? political risk may be diversifiable to some extent, all right? If it's associated with a single country, there are, how you would diversify that political risk. You could look at another country, all right? So you may try to have a presence in another country as well to help to diversify that risk. So multinationals can use geographic diversification of foreign investments as a means of reducing political risk. And of course, you can minimize the political risk. You're going to want to negotiate with the country in question, with the government. You're going to want to hire a lawyer, all right? You may want to even hire a financial consultant. So there are ways that you can, I know that's not on the slide, there are ways that you can minimize your exposure. You can form a joint venture with a local company, all right? Because if the project is partially owned by the local company, the foreign government is less inclined to expropriate. Basically, they're going to take some money from you. They're less inclined to take some money from you if you have a local partner, all right? You may want to form a consortium of international companies to undertake the foreign projects. So these are some other ways, all right? Multinationals can use local debt finance to finance a foreign project, which a lot of them are doing now, all right? So that the multinational can renounce its debt if the host government takes action to hurt its interests. So basically, they're pulling out, they're not paying the debt, they can always do that. Multinationals can purchase insurance against the hazard of political risk, all right? You're not going to find those kind of policies in these smaller islands, but they are available, all right? In the US, there's the Overseas Private Investment Corporation, or OPIC, and that offers insurance against inconvertibility of foreign currencies, expropriation of US-owned assets overseas, destruction of US-owned physical properties due to war, revolution, other violent political events, and loss of business. So there is insurance for that in some parts of the world. All right. When the risk can be covered by insurance, then you also subtract that from your net cash flows. You're paying the insurance, so when you're evaluating your project, when you're deciding whether to take on this project of expanding or not, you would include that in your deducted from your net operating cash flows. You can use usual cost of capital, or you can use the cost of capital in country, in the local country where you're investing as well. So of course, you know, there's corruption all over the world, all over the world, and so that's how governments tend to get money. So you have politicians who will get money, as we say, under the table. Sometimes they don't see it as under the table, they see it as like finder's fee kind of thing. So that is a factor in multinational, in expansion across the world. So what companies have been doing is to quote unquote internationalize their capital structure, so they raise the funds both from their home country and from the foreign country. all right? And so what the companies are really trying to do there is to lower their cost of capital, and as they try to reduce their costs. There's deregulation of the international financial markets, which helps because you can raise funds on the international financial markets in the form of equities. We did that. Remember, we did international equities and how you can raise funds on the international financial market. And so, in terms of capital structure, you can take loans in the foreign country, in your home country. You can raise monies on the capital markets, both in the foreign country and in your country, because you can do an IPO in the foreign country, but you have to do the legal side of things. All right? So that's by way of capital structure. And the cost of capital, that's the minimum rate of return an investment project must generate in order to pay its financing costs. So the cost of capital, if you didn't learn it in FM, is the minimum rate of return an investment project must generate in order to pay its financing costs. So you have to try to ensure that, or you should ensure, not try to ensure, but you should ensure that the return on the project is going to be at least equal to your cost of capital. So your cost of capital refers to what again? The cost of raising your funds, which refers to what? Cost of equity, your cost of debt, and you're going to, depending on your percentage debt and your percentage equity, you're going to find your weighted average cost of capital, and you're going to compare that to the return on your investment. No, I'm not teaching you. You can take notes if you want to, but I'm hoping that it helps you with your FM. Okay? So you want to be sure that your return on investment is at least your cost of capital. You want it to be more, of course, all right, for your investment to make money. So if the return on investment is equal to the cost of capital, then the value of your firm should not change. If it's less, then you're going to have to eat into your equity, or it's going to eat into your equity, and the value of your firm is going to reduce. All right? So a value maximizing firm should always try to lower its cost of capital, and that is why they use the technique of taking some of their financing from the country that they're expanding to and taking some of it from home. You look to see which one is more beneficial, bearing in mind we also have that foreign exchange risk as well. Okay? Any questions there? So when you have both debt and equity, your financing cost is represented by your weighted average cost of capital. If you're looking at, when you're looking at your cost of equity capital, you now also need to look at the risk that you are facing there. So you may need to go in and use your capital asset pricing model. So your weighted average cost of capital, you weight the after-tax borrowing cost. All right, so your after-tax cost of borrowing plus your cost of equity. So like I was saying, if you're doing a 50-50 equity and debt, if it's 50%, then your weighted average cost of capital is going to be equal to what? However, with your cost of debt, you're going to have to include your bond minus your tax. Okay? Anyways, you can write that down, you know, check it, but make sure that I know the right. Okay? I'm not teaching FM this year, so. No, I'm not teaching FM. All right, so that's the formula up there. All right? Where your K, the weighted average cost of capital. KI is the cost of equity capital for a leverage firm. I is your before tax cost of debt capital. This little symbol here, can't remember the name of that one. Marginal corporate income tax rate, and your lambda is your debt to total market value ratio. So your total capital is 50 million. Your equity is 30, your debt is 20. Your cost of capital is going to be 30 over 50 times your cost of equity, yeah, right? Plus 20 over 50 your cost of debt times 1 minus your tax rate. So that's just an example. All right? No, I'm not giving you cost of capital, weighted average cost of capital on your exam. No, I'm not. You won't have to calculate. You know, every time I just mention, next week we'll talk about that. All right? We'll talk about that next week. Okay, so both your cost of equity and your before tax cost of debt capital will increase as a proportion of the debt in the firm's capital structure increases. So both your cost of equity and the before tax cost of debt will increase as a proportion of the debt in the firm's capital structure increases. So if your debt increases, the whole thing is going to increase. All right? To be able to reduce your average cost of capital, you need to find that optimal combination of debt and equity. All right? And so companies may be incentivized to use your debt financing because in debt financing, you can deduct the tax on your interest payment. You can deduct your interest payments from your tax. So that's why you see that little part always added in, because you can deduct the interest payment. And so debt, raising your capital by debt is usually more attractive. All right? Usually more attractive. Dividend payments are not tax deductible. You have to pay taxes on those. And so companies tend to use debt financing. But when you're thinking about debt financing, you need to think about bankruptcy costs. If you end up bankrupt because of debt, you can't cover your debt. The cost of bankruptcy is major, because cost of bankruptcy is not only dollar cost, but it's your firm's reputation, the reputation of your CFO, your CEO. Usually the CFO gets fired, you know, so you always want to look for that lowest cost of capital by optimizing your capital structure. And so usually the trade-off between the tax advantage and the potential bankruptcy cost would be the key factor in determining your optimal capital structure. And so what companies tend to do is to not just use the NPV to value the project, but to use your internal rate of return, because you want to see how the return on the project all right? And you should know that your internal rate of return is that rate that's going to make your NPV 0, all right? But your internal rate of return, you want to make sure that it exceeds your cost of capital before you undertake that project. So in terms of computing, sorry, I need to sit for a moment. So when you are calculating your financing costs, you have to, your cost of debt is pretty straightforward because if you're issuing bonds, you know what your rate is going to be. If you are going to the bank for financing, you know what that cost is going to be, right? It's your cost of equity that is the dicey one, because your cost of equity is what is the expected return on your stock, okay? Usually, you need to use the capital asset pricing model to find that. And so, you're gonna have to be hiring, hopefully, a good investment analyst that's going to help you, that's gonna work along with your chief financial officer to work that out. So, your return on equity, usually we use the capital asset pricing model, which pretty much says the expected return of the stock is dependent on the risk, any risk in the security. So the return on your stock here is your risk-free rate plus or minus the return on the market minus the risk-free rate times the risk of your stock. Now, if you aren't able to do those calculations, you may not optimize your capital structure. All right? So you need to figure out the expected return on the stock that you need to get to be able to optimize your capital structure. Because you know what the debt is, you already know that rate, you now need to find the return on your equity. All right? So just, in the formula, RF is the risk-free rate of return. Your risk-free rate is the return on treasuries. All right? RM, as I indicated, is expected return on the market portfolio. And beta is your risk measure of the security that you're using. And beta is systematic risk, that's the risk that you can't get rid of. All right, so you take that into consideration. So greater the market risk, the greater the expected return. However, because the greater the risk, the greater the return, you have to understand that the risk means you may not get that return that you're looking for. All right? So you take the risk, bearing in mind that you may not get that return. And then the way I'm just outlining here how you calculate the beta or the risk on your security. Obviously, except we started doing this at the beginning of the semester, it's not something that you can just learn today, so I'm not something I'm holding you to, but you just need to be aware of it. You need to be aware that that exists. All right. So, if the international financial markets are fully integrated and investors can diversify internationally, then you wouldn't just have your domestic market portfolio, but you'd have a world market portfolio. So you'd have a capital asset pricing model for the world. All right? And so if there's full integration of financial markets, then you could diversify away a lot of the risk that's there. But as a multinational corporation, you have access to the world market, all right? And in having access to the world market, you need to take into consideration the risk of the world market as well, especially if you're participating, if your company is traded on multiple exchanges, all right? In the integrated international financial markets, your future cash flows will be priced the same way in every country, all right? And so investors are going to look for the lower expected return on securities on the integration than on the just one market, all right? Because they can diversify better on the integration. So basically, and we said this before, a company can benefit from cross-border listing of its shares, all right? We spoke about that earlier when we spoke about international equity investment. So it can expand its investor base, which is going to give you a higher stock price and a lower cost of capital. Cross-listing also provides a secondary market for your company's shares, all right? And this will help the company to raise new capital in foreign markets. Cross-listing can enhance the liquidity of the company's stock. Cross-listing enhances the visibility of the company's name and its products in foreign markets. Cross-listed shares may be used as acquisition currency for taking over companies. Cross-listing may improve the company's corporate governance and transparency. So these are several benefits of cross-listing. But then just take a step back. What's involved in cross-listing? How do you cross-list? Go back to your international equity markets notes, all right? Now, there are many benefits, but not all companies want overseas listing to be because there are costs to that. And that's why I said, go back to your international equity market notes. It's costly to meet the disclosure and listing requirements, all right? Also remember that if you're trading in the overseas market, whatever volatility and risk are in that market, you're going to get it. If your stock is available to foreigners, they might acquire a controlling interest and challenge the domestic control of the company. Some companies are okay with that, all right? But those are just things to consider. Remember, if you are listing overseas, it means that you're going to have to prepare financial statements and you're going to have to submit those to the regulator. So you're going to have to submit to the regulator in your country and you have to submit to the regulator in the country in which you have expanded or you have listed, and the requirements may be different, all right? Because not all countries have exactly the same regulations or financial statement requirements. Some countries have more disclosures than others, right? So when you talk about international cross-listing, you need to understand the pricing of assets, all right? In each capital market, the pricing may be different, all right? So you have something called the international asset pricing model, okay? To facilitate those assets that are internationally tradable. Cross-listed assets are considered to be all internationally tradable, and then the others are not. So if you're looking at that, the CAPM, or the capital asset pricing model equation, we will have to rewrite it, and it looks something like that. All right. Bearing in mind, your RM here is your world market. It's the, okay? It's the return on the world market, not the return on the domestic market. All right, so your RF is your risk rate of return, RM is the expected return on your market portfolio, but remember this is your market, your whole market. All right, and then of course, your beta, this part is what you're going to get your beta from, or your BI, if you remember what the formula was before. All right, and it's the variance of return on the market times the covariance of the return on the stock and the return on the market. Bearing in mind the return on the market here is the world market. All right, not going to spend too much time on that. But just to note, just something else you need to know, if the international financial markets are segmented, not integrated, that means, then you can only diversify domestic. All right? So in this case, the market portfolio, the Kaplan formula, would be your domestic portfolio, not the market. All right? In segmented markets, the cash flows will be different across countries. So if you are in more than one jurisdiction, you're gonna have to do separate cash flows for each jurisdiction. Right? And I think what's on this slide, I already said it. And very important, another disadvantage or consideration is that financial managers of multinational corporations often have difficulties in determining what the financial structure of their foreign subsidiary should be. So domestically, you know, your capital structure is going to be your debt and your equity, or just all equity, or just all debt, and you know what's involved because you know your market. Your foreign subsidiary, now you need to consider everything. So you need to consider political risk, you need to consider all the regulation, you need to consider whether the markets are integrated or not, you need to consider whether the market is deep enough or not. You need to consider, you need to look at debt financing in those markets, all right? So you need to focus on those things. So Lazard and Shapiro make some suggestions as to how you would approach your subsidiary's financial structure. So one, you conform to what happens in the parent company, make it easy, you just stick with that. Two, you conform to the local norm of the country where the subsidiary operates. What happens in that country? Do they use all equity financing, or do they just use all debt financing? Here in Antigua, they tend to use all debt financing. Or you may vary to capitalize on opportunities such as lower taxes, reducing your financing costs and your risk, market imperfections. So your approach is going to depend on what's happening in the market. All right? But of course, as a multinational company, your board of directors will have to say, yes, you can do it this way. They may decide to just keep it to the parent company's norm. All right? Once the parent company is fully responsible for the subsidiary's obligations, then the financial structure of the subsidiary is not going to make a difference. It's not relevant. All right? So it's the parent company structure that's going to be important in this case. If the parent company wants to allow the subsidiary to default, or the parent company, the parent guarantees its subsidiary's financial obligation, then If it's difficult to cross borders, then this financial structure is going to be relevant. All right, so that's just important to know. And this is really, the last two slides are really just talking about, it's really just a summary of everything that I said before. All right, so shareholder wealth is created when the firm makes an investment that will return more in a present value sense than the investment cost. So that just summarizes what I've said. The generally accepted methodology in modern finance is to use the net present value discounted cash flow model, but we still use the IRR, but the NPV is the generally accepted one. A firm that could source funds internationally rather than just domestically could have a lower cost of capital than a domestic firm because of more opportunities to raise funds. Low cost of capital means that more capital projects will have a positive net present value for a multinational firm. Then we have something called the adjusted present value method, which is an extension of the NPV technique, and the adjusted present value, you would adjust it in certain conditions. We won't get into that now, but it's another method. And we know what the NPV is. It's the present value of all the cash flows, including those at the end of the project life, minus the present value of all the cash flows. And the rule is to accept the project if the NPV is greater than or equal to 0, reject it if it's less than 0. Just a very important point, especially for the people doing FM, remember the cash flow at the end of the project's life. So when in the question they tell you that your what you call it again?
The salvage value.
Salvage value, yes. The salvage value is this. You need to include that as a cash flow. All right? In capital budgeting, our concern is only with the change in the firm's total cash flows that are attributable to capital expenditure. All right? Folks, I'm right on time, no, maybe 2 minutes over. That concludes International Financial Management in terms of the topics that you are required to know. And so, what was important today was to note that what we did in the end, we started talking about it at the beginning. And this was a summary. This was really a summary of everything we have done throughout the semester. I trust that what we did, I'll let you know just now. I trust that what we would have done in this class will redound to your benefit, that you will remember it, you will apply it where necessary. I know many of you just can't wait for May, whatever date to come. Please come next week. We are going to be reviewing.
Oh, okay. Well, I was gonna ask if you were gonna give us a study guide.
No, give me a study guide. I will tell you, hello, no. I'm not giving you a study guide. We will discuss the format of the exam. I will emphasize certain areas, but you are responsible for every single topic we cover.
You realize both of your courses, like the exams are like back to back.
And they benefit each other. You can use the knowledge from one to help
I
you
can't
with
tell
the
the difference
other.
between each other.
Oh, it's best for everybody.
I don't